Hello, Matthew Bell with InsurancePrescription.com, and today I want to talk about ways that you can save on your life insurance premiums. Now, the first thing is I'm going to give you a number of tips, quick tips for doing this, but the first thing I want to address, just a couple of preliminaries, and one is not relying on group term insurance. So there's a strategy that some people utilize at this point when you want to say, well, to save money on life insurance, don't buy it, utilize your group term insurance. Certainly, if you have term insurance through your employer as a free benefit, then obviously you want to take it. And for many people, it makes sense to tack a few bucks on in order to kind of increase some of the coverage for them or for their family members, because it is often available at a very low cost. But there are a number of considerations that sometimes weigh heavily against relying on it exclusively. I'm just going to give two here. I'll get into it more in another video. But the first one is that you don't take it with you. It's connected to your service. So if you are unemployed, if you get fired, if you quit, if you are placed on inactive status, it can put your benefits into question, and that will include your life insurance. The second quick reason that I'll give for not relying exclusively on group term is that its coverage levels are often inadequate. Now, there is no one particular method for calculating what your insurance need is. I've gone into this in other videos. I'll put the link in the description. But there are at least, let's say, 5 different calculation approaches that you can take. And essentially, your life insurance need number is going to depend on the calculation method that you utilize and a number of other things regarding assumptions. On almost any way of calculating your need is going to surpass what is available to you, at least for free, through your group term. And if you're going to pay extra for it, you may as well have some of the portability, some of the convertibility, and other options that go along with having privately owned insurance. So I'll get into that more in another video because it does deserve a longer treatment for sure. Some people, can it make sense for them to have a reliance on group term? Maybe if they're completely unhealthy and they couldn't get insurance otherwise, yeah, absolutely. But for many people, it's not going to go that way. And so for those people, for you guys, most of you, I'm going to give you 12 tips on how to save on your private life insurance. So the first tip is going to be buy young. And I know this is easy to say. You can't go back in time, obviously, and purchase a policy in the past, although I'm going to put a little asterisk on that, and we'll get to it in just a moment. I'm going to tell you that you right now are as young as you're going to get. I'm sorry to break it to you. 5 minutes from now, you're going to be older. A week from now, a year from now, none of us are getting any younger. And so the idea of buying young, obviously, if you are in a position to buy it and you are 20 years old, or you're buying it for a son or daughter, or you have some ability literally to buy it young on some kind of an objective scale regarding life expectancy, then do it. But one of the corollaries of this tip is just don't put it off. Don't procrastinate. If you know you have a life insurance need, it's not going to get any better. You're going to simply find that your rates are going to go up. Your options are going to be reduced. Some insurers may not deal with you. You may find that you have health problems that manifest. There can be all number of things that crop up, so don't put it off. The second tip is going to be select the most appropriate type of insurance for you and for your application. This is going to be a conversation that you're probably going to have with an insurance agent, or with multiple agents, with a broker, with your financial planner, with somebody who's in a position to know some of the options that are available to you, and somebody that you trust. Now, in many articles that you read on tips for saving money, they're just going to say use term instead of whole life. But I feel like that is not always the best for everybody. It's not going to be the best for everybody. It's one thing to try and save money on your grocery bills by buying ramen noodles and tuna fish and eating that every day. And I'm sure you could save money on your grocery bills if that was the strategy that you implemented. But it is likely, implementing that strategy, that you're going to have health problems down the road because you're not eating a balanced diet. And so you might save today a few bucks by buying ramen noodles and tuna and not eating anything else. But down the road, you may find yourself paying more in terms of medical costs or medical care because of those choices. Now, I'm not saying that term policies are going to cause you medical problems, but there are other reasons when you take a holistic view of your portfolio, of your retirement plan, of your estate plan, and so on. There are other reasons why you might want to put a little bit into some kind of a whole life policy, a universal life policy. This is not the place to get into that, But the first and primary takeaway here is that in order to save money on your life insurance, you need to make sure you have the appropriate vehicle. Maybe it is term for you, maybe it is, and maybe you would be better off getting a term policy than a whole life policy in your situation because you're going to save a few dollars in premium that are better spent elsewhere, and maybe not. Now, the third tip is going to be once you have decided on a particular type of policy, then you want to compare. You want to do comparison shopping. You want to maybe price it around. You can do that online sometimes. Sometimes you can incorporate an agent into this discussion, somebody who's got access to multiple product lines and can check prices for you, a broker, and you're well advised to try and get the best rate by shopping around. Now, the fourth tip is going to be you want to make sure that you've focused on your health. Now, this is a very general point, but being in good shape, being height, weight, proportionate, taking care of medical issues as they arise, trying to make sure you are eating a balanced diet and have vitamins and the like of this, whatever your particular, and this is not a channel here on healthcare or on diet, but trying to make sure you're in the best condition possible is going to be a money saver for you when it comes time to being insured, because obviously part of the calculation is what is the likelihood that you're going to die, and so your mortality is interconnected with your morbidity, your health, and so you are more likely to die if you are in worse shape or if your height, weight disproportionate, and so on. And you have to realize that part of the comparison shopping is going to be hampered by the fact that you really need to go through underwriting in order to fix what your rate is. It's one thing to look at insurers and kind of get a sense of where their rates are in general, but many of them have sometimes a dozen or more different underwriting classifications or different surcharges that can be applied depending on your health, and it really gets to a point where you have to go through the underwriting process in order to actually ascertain what your specific rate's going to be. And an extension of the fourth tip then for doing general health and trying to maintain a general level of health is going to be to try and stop using tobacco if you are a tobacco user, and that could be smoking, it could be chewing tobacco, it could be vaping. There are a number of different avenues for this, but if you are a tobacco user, you generally are going to pay more for your life insurance premiums. Now, the fifth tip is going to be to go through the underwriting process. I said already that it's important to go through underwriting just to get what your rate is, but the second part of this is going to be if there is the offer of having one policy that's guaranteed issue and you don't have to have any medical underwriting and another policy that you would get with medical underwriting only, the policy that is going to implicate you in medical underwriting is going to potentially save you money if you're healthy. And the reason for that is if the insurance company can find out that you're healthy, then they will give you essentially a better rate than they would if they have to assume that there's something going on. Because without the information that they would gather from a paramedical or from an inspection of your medical records, the insurance company is going to have to err on the side of caution. The less information they have, the more they're going to assume you're unhealthy. And a guaranteed issue policy is something of the ultimate case of this, the extreme case where for many guaranteed issue policies, the assumption is that you simply are uninsurable, that you are so unhealthy that you can't get insurance any other place. And by the way, group term also has that kind of an element. And if you want the fancy word for it, it's called adverse selection. The idea being that some people who avail themselves of group term coverage during open enrollment, there's no medical underwriting, so anybody can just sign up as long as you're healthy enough to be an active employee. But that means that the group term administrators are going to be assuming that there's a non-negligible subset of people who are otherwise uninsurable who are taking advantage of those group term benefits. And everybody else is going to pay. Now, the sixth tip is going to be buy in bulk. And this kind of seems strange when you think of insurance, but essentially it means that larger face amounts often have what are called banded rates. If you get $1 million, in other words, you're probably going to pay less per thousand of insurance coverage than you would if you only have a $100,000 policy or a $10,000 policy. So obviously this is not a reason to make the coverage level more than what you need or what is justifiable in your situation, but it is to say that if you're debating between having $1 million of coverage, which maybe one needs analysis says that you require, and having 500,000, you can be mindful of the fact that the $1 million coverage level might just be cheaper when you consider cost per thousand. Now, a seventh tip is going to be to layer the policies or to stagger them. That is to say, if you need $1 million of coverage now, but part of the reason is that you have a $250,000 mortgage and you know that you are 10 years away from paying the mortgage, but you also know that you would like your term coverage to go out, let's say 20 years. Let's say you are 45 years old and you plan to retire at 65, and so you think, okay, I'm going to have 20 years of coverage that I would like this term to cover. Well, one solution to that problem would be to buy a 20-year policy at $750,000 and a 10-year policy at $250,000, because then you have your total $1 million worth of coverage, but after your mortgage is paid off in 10 years, one of those policies drops away and the premium will drop away with it. And so you can save money, maybe not today, but you can put in place a strategy today that's going to help save you money in the long term. I'll get into that more in another video. Now, another tip, and I said early on you can't go back in time, and I put an asterisk on it, there is something called saving age, sometimes called backdating, where the idea is that you are able to take an application and put a date on the application that's earlier than the date you're actually signing it. And it's legal in life insurance situations within a certain spectrum, usually not more than 6 months of backdating is permitted. But the idea is that life insurance goes by half birthdays. Once you hit your half birthday, your rated age goes up. So the idea in backdating is that it might be possible to put the application date as earlier than the actual date that the documents are signed in order to qualify you for a slightly better rate. And the idea here is that every year your insurance, assuming your health stays the same, every year you get older, your insurance rates are going to go up slightly just because of your age. And so if you're able to save age or roll the clock back, let's say 6 months, then it can potentially save you money going forward. Now you have to be mindful when you do that you are going to owe 6 months of premium up front. So if you're paying monthly, it might be a little harder to come up with 6 months of premium up front. But if you're paying annually, it may not make any difference to you, and it's something to keep in mind. Now the 9th tip is going to be the assumption that you have a policy already. So on many of the tips that I've just gone through very quickly, the assumption is that you're writing a new application. But on this tip, let's say you have a policy in place, well, you could consider replacing the policy. That's tip number 9. Replacing the policy then is going to put you back through all of the other tips that we just said. Shopping around, making sure you know what your insurance requirements are, trying to make sure you go through underwriting to get the best rate, and so on. Whether or not you replace a policy obviously is going to depend on how the numbers come out. Never kill one policy until you have another one in hand, and the best you can do is just try and go through the process and then compare. What is the new offer compared to what you have already? And if the new one stands to save you a little bit money, all things being equal, you might prefer it. Now, a related tip is going to be to try and get re-rated. Now, something that can hamper you both in replacement and re-rating is, of course, the fact that you are getting older, and so every time you do a re-rating, the insurance company is going to re-rate you at your current age rather than at the age that you got the original application. But it can make sense in some cases. So for instance, let's say you took out a policy 10 years ago, and at that time you were a tobacco user and you were 10 pounds overweight, and now you have quit using tobacco and you're at normal height-weight ratios for your particular age group. Well, in that case, you might qualify for a better rate. And the better rate, even at 10 years older, might be less money than the rated premium that you had qualified for previously. Is it definitely going to be the case? No. You have to go through the process. So sometimes this is called re-rating, reevaluation, requalification. Essentially, it's just sending you back through underwriting so that you can be re-underwritten to get a fix on how healthy you are. And it can pay off. An 11th tip is going to be to change your pay mode. Now, pay mode is just another way of saying what is the frequency with which you write checks or that premiums are drafted to the insurance company. So if you pay monthly, your pay mode is monthly. The options generally are monthly, quarterly, that is every 3 months, semi-annually or every 6 months, and annually or every year. In general terms, the fewer payments you make, the less expensive your overall cost is. So if you take your monthly payments and multiply them out over the course of the year. So let's say you have a $100 premium payment per month. Over the course of 12 months, you pay $1,200. Well, for the same policy, if you were able to pay it with one payment, let's say an annual payment, maybe you'd save yourself $25 if you paid it all in advance. Now, of course, you have to come up with a bigger chunk of money. However, it might benefit you and it might save you a few bucks. Now, even if you can bump it from monthly to quarterly, it might save you. Sometimes it does, and sometimes it doesn't. And there are a number of reasons for this, but I would simply say the basic point of the tip is explore whether changing your pay mode, even if you hold everything else fixed, might stand to save you a few dollars. And the final tip, number 12, is to change and look at your dividend option. So dividend options are only available on certain policies, and I get into this in another video more in depth, but if you have a policy that is eligible to receive a dividend, bear in mind that you can receive that dividend in a number of different ways. One way is have the dividend go back into the policy in order to make the policy grow. This is generally going to be the case with whole life policies, maybe universal life policies, something that has cash value associated with it. But another option that can be utilized with a dividend eligible policy is to enable the dividend to be put towards the premium, and that can save you money. Now, it can also cause the policy to not grow the same way as it would have grown if the dividends were going back into the policy to make the policy grow. And you should bear that in mind, because if you got that policy on the supposition that it was going to grow a certain way, tinkering with the dividend option is going to alter the projection. But if you're strapped for cash, and if the more important thing for you now is to save a few dollars, you should be aware that that's a potential option for you. So I've gone through 12 tips. I hope something I said was of use to you. If it was, I ask that you please like the video, click the subscription button, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video. Thank you.